The Chinese stock market is quite literally imploding, with it having put in the worst one-day decline in the history of the Chinese economy. At one point in pre-market, the Hang Seng index was down almost 15%, and at the day of close, it has put in its worst day since 2008. So does this mean it's the end of the road for any Chinese stock market investor, especially in the EV sector like Nio and Xpeng, whose stocks declined on average 15% on Monday? Well, that question is exactly what I want to address in this video. I'm going to lay out both the pros and the cons of investing in the China market today, and I am absolutely not going to sugarcoat anything because obviously you guys want to hear the truth. So strap in, folks, because we have a lot of charts and data to look at and potentially a lot of controversial opinions from myself. But as usual, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So let's start things off by addressing the timeline of the past 3 days, which led to this massive decline in the Chinese stock market, which has officially capitulated a lot of retail investors. Well, this entire disaster started brewing last week when the Chinese elections were taking place and Xi Jinping was expected to yet again get re-elected for his third term. And so then what happened on Sunday that scared almost all investors in China? Well, this event right here. The previous Chinese president was getting escorted out forcefully from the Congress on command by Xi Jinping. This was a sign Xi Jinping is potentially going to gain more control over the Chinese economy than most investors had initially predicted, and that turned out to be true. And well, that's certainly what happened. Xi Jinping ended up electing officials in his nearest circle of confluence that were aligned primarily with his viewpoint around the Chinese economy. So chances are his cabinet is not going to block any of the positions or policies that he entails, which is exactly what is causing so much fear in the Chinese stock market, as investors don't want to see the effects of 2021 all over again when we saw the tech crackdown on Alibaba and all e-commerce companies in the country. And well, this caused the Hong Kong Hang Seng index, which is dominated by Chinese businesses, to report one of its worst declines since the global financial crisis, scaring out almost all retail investors here in the US. And well, why do I think that? Well, because Nio, BYD, and Chinese EV stocks like Xpeng and Li Auto were at the peak down almost 22% in a single trading day. And that was not just a gap down, that was actually during market hours, which means that a lot of stop losses were triggered and a lot of investors were selling into the panic. So I guess that is probably the end of the road. There is no fundamentals left in China, the economy is a complete shit show, and Chinese stocks are simply not trustworthy, which is why most US investors have completely lost confidence in them. Well, as I'm about to share, that is not the whole story. I personally have not sold a single share in any one of my Chinese equity positions. Now, most folks will call me crazy for that, but that is exactly what I want to see, because 99% of people don't make money investing in the stock market because they use short-term fear as an investment decision for long-term positions. When it comes to the actual physics of buying and selling stocks, it's not very difficult. But the hard part is holding onto your conviction when everybody else thinks you're crazy. And that is exactly why most folks simply are not cut out for the investing world, and I am starting to see that in the community on social media and YouTube, where so many people are getting tricked into selling their favorite businesses based on news catalysts and macroeconomic events, which are always temporary. But I'm sure there's folks saying the stock is down so much, so that means that my investment is probably wrong. Well, that is not the case, because my investment time horizon is not 2 weeks, it's not 3 months, it's not 6 months, it's not even 10 months. It's over 3 to 5 years at the minimum. Now, it depends on what the stock does, and if my valuation targets are hit already and the business is still sound, then chances are I will use that opportunity to sell my position. But right now is not the time to sell unless you've lost conviction in your companies because of what has happened. Instead, we have seen these kinds of declines in the Chinese stock market numerous times over the past 40 years, and every single time at the bottom, people are panic selling, there's way too much FUD, and the bearish argument always sounds really good. Let me say that once more for the people in the back. The bears always sound very smart at the bottom of bear markets because their argument all of a sudden starts convincing most investors that the current trend is going to continue to the downside and there is no hope for another recovery. But little do they know, that is exactly what leads to the bounce in the stock market and the eventual bottom. I'm not predicting what's going to happen in the short term. These stocks that I invest in could again be at the same price or lower in the next 6 months. But my job is simply to make sure that when I sell my position, whenever it may be in the next 2 to 3 years, 5 years, that I will sell it for a higher price than I bought it for. And even though right now my average cost basis is way higher than where these stocks are trading at right now, I'm simply not even looking to sell them anytime soon because my investment time horizon has just not played out. And funnily enough, if you want to actually look at the fundamentals of the Chinese economy and not predict some conspiracy theory about what Xi Jinping will actually do, they actually reported a good number with their GDP data. Their GDP grew 3.9% from 0.4% in the second quarter, which is obviously an insane recovery from the lockdowns of May. And well, why exactly was this such a big surprise? Well, because the Western media has been predicting a collapse in the Chinese economy for the past 2 months. Everything on social media around China has been extremely negative as people are completely ditching their investments in the country. But the data is showing us the fundamentals are actually still strong. Now, it's a completely whole debate if you believe these numbers, because at that point, you're just entering the conspiracy theory and tinfoil hat era. But again, my job is simply to look at the numbers that I have in front of me to judge my investment decisions. Because now if you want to bring in conspiracy theories and question the validity of any of these numbers you see online, you can make those questions for anything you see on the internet, and that's a bigger debate than just the stock market and investments. I can say the same thing for any number in the US. I can say the CPI is fake, I can say the GDP data is fake, and then this recessionary information is all fake. But again, that's not really helping me because investors are making decisions based on whatever is out there already. Now, yes, China's GDP is still way below the pre-pandemic levels, but it's on a strong path to recovery, especially if you account for the fact that the US GDP is on a decline and so is the European GDP well underneath 2 to 3%. China's year-end target, for example, is 5.5%, which is still significantly lower from where they ended up peaking back in the first quarter of 2021, north of 16%. And as you can clearly see, the pre-pandemic pace of GDP growth sits right there around 5 to 6%, which means that if China can even hit their 2022 goals, they'll basically have recovered from the pre-pandemic losses. But I think it's time to address the elephant in the room apart from just the stock price performance and the fundamentals. We need to address Xi Jinping and what he could do for the stock market, which is the number one reason stocks are selling off so much. You see, the market is basically pricing in that Xi Jinping's power and authority is going to delist any stock in the United States as investors rush out of them because they think the Chinese president's main motive is to cut growth of the country and focus on political stability and security. And well, they're probably right, and they deserve to get out of the market if they believe that invalidates their thesis. But the thing they're completely forgetting is the other side of the coin, which is the fact that China wants to maintain a technology leadership in the world. It's really funny. I see so many people in the Western media saying that China's gone, China is a complete scam, and the economy is collapsing. Yet they write that on an iPhone or a computer that was probably made in China with battery cells that were procured and also manufactured in China. And in 20, 30 years from now, when they're using some sort of AI software to better their lives, chances are that software was coded somewhere in China using technology and silicon that was probably also manufactured in China, given that China has the biggest market share of battery makers. More than 2/3 of the global battery cell production capacity is housed in China. So if you think that the Chinese economy is on the brink of a never-ending collapse, then you probably also think the entire world is at risk of a complete meltdown. Because if the Chinese economy collapses, that's going to have massive ripple effects across the entire world, because those guys simply produce stuff way too cheaply. Get ready to pay another grand for your iPhone next time China collapses, because that is exactly what's going to happen, and Apple stock is probably going to collapse by over 50%, given that most of their manufacturing is done in that country. And guess what happens when Apple stock collapses 50%? The S&P 500 is going to be down another 30%, and chances are there's no recovery in sight because most everybody in the consumer business in America uses Apple products. And guess what the true reality of the situation is? China wants to maintain a technology leadership. So if you're investing in the right businesses, the ones that can still thrive under Xi Jinping, which is obviously something in the tech space and innovation area, then you're probably going to do just fine, even if Xi Jinping focuses more on political stability and security. And guess what's one of the fastest growing industries in China? Electric vehicles and battery cell manufacturing. And that is precisely why, if you pick the right businesses, you can actually perform better than what the Chinese stock market right now is showing you. I mean, there's a reason why the US is banning chip supplies to quantum computing and AI businesses in China. They know that China is growing at a ridiculous pace, and yes, even though their population is slowing, their efficiency increases over the past 5 years is simply undeniable. And that's why businesses like Xpeng and even Nio are still innovating at a ridiculously high level, having launched one of the first almost full autonomous driving vehicles with the Xpeng G9. And that doesn't even get us started on the flying car and robo-taxi technology Xpeng recently demoed at their 1024 Tech Day, which again could be one of the technologies that China wants to be dominant in, and as a result could allocate a big amount of capital towards for investors. But obviously guys, that is just my take on the situation, and it's always good to hear the other side's perspective. Let me know your thoughts down in the comment section below.